The U.S. banking system is being set up for a disaster as December home sales have slumped to close out the worst year in 30 years. You can see from this report from CNBC, December home sales were down 6.2% year over year, and full year home sales for 2023 came in at 4.09 million units, the lowest tally since 1995. And think about just how many more people there are in the country, how much bigger the population is than it was 30 years ago, and yet today, lower home sales than at that time. And this is a sign of a looming economic crisis, the likes of which we haven't seen since the Great Depression, and the Federal Reserve is going to be printing massive quantities of money, massive quantities of fiat dollars before all is said and done. And that's why I'm stacking gold and silver. Don't forget, you can stack gold and silver at SD Bullion, today's video sponsor. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Hello to everybody joining the live stream. Please smash that like button, share the video with your friends. And now let's talk about this pending banking disaster. Of course, we are still in the midst of a banking crisis that began in 2023. It's larger if you take a tally of all the banks that have failed than the 2008 financial crisis. So it's not done yet. And right now, here's a headline from Reuters from today. U.S. banks warn costly deposits to weaken interest income in 2024. After more than a year of booking strong profits on the back of the high interest rate they were able to charge on loans, banks are contending with a string of challenges heading into 2024, including weaker loan growth and potentially tougher capital rules. Now, what kind of loans does the bank make to consumers? Well, a lot of those are mortgages. And what did we just see? Well, we saw home sales hitting the lowest level in 30 years as of December. So the banks are not going to have that line of business, and yet their deposits, that the depositors who are holding accounts in the bank, the interest that the banks are having to pay out is continuing to remain elevated as a result of Fed rate hikes. And this is just one more reason that our debt-addicted economy, our over-leveraged economy, our huge bubble economy, which has been inflated by the Federal Reserve for the past 2 decades plus, cannot sustain these high interest rates. I mean, high is relative, I guess, but we can't even take a federal funds rate north of 5% without the banks incurring massive losses. And we're going to talk about some more evidence that that is coming in just a moment. Rate cuts from the Federal Reserve later this year could ease some pressure on banks to raise deposit costs further, but some of the central bank's policymakers have cautioned the elevated rates may need to stick around for longer to bring inflation down to its 2% target, such as Fed Governor Waller putting a hawkish spin on Fed policy moving forward. And you can see markets are now beginning to anticipate less than a 50% chance of the Fed cutting rates at the March FOMC meeting. Now, the consensus is, according to the CME FedWatch tool here, that we're going to have to wait until May before we see any rate cuts. Now, I don't know what the Fed is going to do in the short term, but I do know that ultimately they are going to be forced to print massive quantities of fiat currency to bail out this financial system, and I suspect it will be sooner rather than later. So this could all absolutely change between now and March, and I think we are just one unexpected event away from that occurring. Just look at the BTFP, the Bank Term Funding Program, the emergency lending facility set up at the onset of the current banking crisis by the Federal Reserve, which according to recent data just hit a new all-time record high of $161 billion of these emergency loans, bailing out the regional banks, the small regional banks who are sitting on piles of devalued federal treasuries, which, as the Federal Reserve has raised rates, these things have come under a tremendous amount of pressure. The banks have unrealized losses, huge unrealized losses. And look at the curve. I mean, last week we were at 147 billion, so we're up $14 billion in 1 week. And you can see the utilization of this emergency facility really beginning to accelerate as this crisis deepens. Just look at the slope from June of 2023 to November. It was almost flat. And then since then, we've seen week after week, higher utilization of this emergency lending facility by regional banks, giving up those low-yielding treasuries that they have unrealized losses on as collateral to the Fed. Now, when this facility runs out in March, what do you think is going to happen? Are the banks going to pay all of these emergency loans back all of a sudden and get their collateral back? Well, if the Fed hasn't begun massively suppressing interest rates on U.S. Treasuries by that point, that's not really going to be an option for these banks because the banks don't even have the money to pay back. The whole point of this facility was to avoid fire sales of those assets, the bank being forced to take huge losses and thus failing, much like what we saw with Silicon Valley Bank. And now they've used that money to make good on their deposits. They needed to raise the capital. So how can they buy these back from the Federal Reserve? Well, they can't unless, of course, the treasuries themselves gain in value significantly. Because remember, the Federal Reserve loaned these banks money against these treasuries, but they took the treasuries at face value, which is a lot more than they're actually worth in the market. So this facility is picking up steam. Now we're seeing $14 billion a week in emergency loans. This is going to be a trend that continues, and ultimately, I don't think the Fed is going to be giving any of these treasuries back. I think they're going to put them on their balance sheet as they are forced to monetize large amounts of debt because of the huge amounts of deficit spending that we are witnessing. Now, on that note, I want to shift gears here a little bit and talk about the continuing escalation in the situation in the Middle East, because this is another reason that the Fed is going to be running the printing presses in a very big way. Of course, war, very costly. Do we have any money to pay for this? No, of course not. We're going to have to borrow it all. With the BRICS nations in the global south no longer functioning as purchasers of U.S. treasuries around the world, this is going to limit our ability to export inflation. The Fed is going to have to get in here, buy up this debt themselves, and we're going to feel it in the value of the U.S. dollar. Now, latest development here, U.S. Navy fighter jets strike Houthi missile launchers in Yemen. The sixth round of airstrikes on these Iranian-backed Houthi rebels, at least that's what we're being led to believe. But remember, this is really not about the Houthis. It's really not about Iran. It is about defending U.S. hegemony in the Middle East, about supporting the petrodollar system, which, if that goes, well, the value of the dollar is likely to plummet significantly along with that system. And so this is something we need to really be paying attention to. Now, what does our president have to say about these continuing airstrikes? Well, this is pretty interesting. I'm going to see if you can hear this audio. I think it's kind of a quiet video, but this is what he had to say when questioned about it.
Working. Well, when you say working, are they stopping the Houthis? No. Are they going to continue? Yes.
All right, so he said the airstrikes are not working because they're not stopping the Houthis, but they are going to continue. So do not expect this Middle East conflict to de-escalate anytime soon. And as long as there is a geopolitical and economic risk to the petrodollar system, which, remember, Saudi Arabia just told us at Davos that they're still considering joining the BRICS nations. What do you think is going to happen when they actually make that move? Well, there's a very good possibility that they may begin pricing their oil exports in non-dollar currencies, and that's what this is all about. So expect this thing to heat up in a very big way. And it's going to mean that the U.S. national debt, now standing north of $34 trillion, is going to expand massively. We don't even have the money to keep our own government running. What did they just vote on Congress on a stopgap measure to avoid a government shutdown? Yeah, we're not going to be able to afford a massive war in the Middle East either, but we're probably going to have one anyway. So how are we going to pay for it? Well, you're not going to get taxed directly. Remember, this is an election year, but you probably are going to be taxed in a fantastic manner via the hidden tax of inflation. In fact, we all are, and that's why I'm continuing to move into hard assets. Anticipation of what the Fed is going to do next, that's what's driving the price of gold and silver at the moment, but that paradigm, I believe, is about to shift, and markets are going to realize that the Fed ultimately is going to be printing far more than we have been led to believe. $34 trillion in debt essentially guarantees it, because all that debt ultimately is going to have to be monetized. Let me know what you think in the comments down below, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.